Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Chris Osmond is in the hot seat again behind the mic with another great guest. Chris, how are you?
I'm doing great, Art. How are you?
I'm doing fantastic. Who did you bring in today?
I am very honored to introduce our guest and someone I consider a friend, Chris Long, the founder and CEO of Palmer Square Capital Management.
Fantastic. What are you guys going to be talking about today?
We are continuing our series on inflation and rising interest rates and potential hedges. Last time we talked about private real estate, and today we're going to be talking about private credit and how it can serve as a potential hedge against rising interest rates and potentially inflation.
Yeah, that is a hot topic. So I'm excited to hear the interview today. Thank you so much for bringing him on the show.
Yep. No, absolutely. And with that, would love to dig in. But before we do that, I would love to introduce our guest, Chris Long. As I mentioned, he's the CEO and founder of Palmer Square. I've had the luxury and privilege to know and invest with him and his wife, Angie, who founded the business for more than 5 years now. And I can say I've been nothing short of pleased with the results and professionalism and market acumen that they consistently deliver. So without further ado and stealing all their thunder, I'd love to bring Chris on and allow him to introduce himself, to provide a little bit of background on him, Palmer Square, so we can all get acclimated.
Chris, thank you so much for the opportunity and kind words. It's been an honor to work with you, your clients, and have done so for an extended period of time now. Chris Long, I will say a few things about myself, but it's really about our firm. I've been doing credit and credit-related alternatives my entire career post-undergrad, so that's 25 years now. And this is one of the most interesting environments where active management is truly critical. Our firm is based in Kansas City with a research office in London. We oversee $23 billion in assets. We have almost 50 team members. And the vantage point I will bring today is this is all we do. We focus on US and Europe, corporate credit and structured credit. So obviously interest rate risk, credit risk, et cetera, are key focus items for our firm.
Great, Chris. Thank you for that introduction. Yeah, it's been fun to watch the growth. I remember when we met, I think started investing me around $5 billion. So it's great to see that growth and well deserved. So without further ado, let's get started on the topic. It's such a timely topic. 2022 has been a rough year for really all capital markets. On the heels of a fiscal spending cliff and a surging dollar that's impacted the U.S. trade imbalance. We actually saw the first quarter contract in terms of GDP. I think no surprise to anyone, inflation is not transitory. It's been extremely persistent and nagging in sorts. Interest rates have really spiked, and in most cases, they've more than doubled across the curve, except for really long bonds, which has also set equity markets in a disarray. And we're now in a bear market, so equity markets have sold off over 20%. Consumer sentiment as of recently is now at an all-time low. Yeah, that's it's amazing. It's just been a very tough environment. In the hopes of choking inflation, the Fed has really started to reverse course for the first time in since the COVID and tighten monetary policy. Their balance sheet ballooned to nearly $9 trillion. And in June, that actually started to reduce for the first time. And they've begun raising interest rates. We saw an announcement just a few minutes ago that they increased 75 basis points, and are expected to aggressively continue to increase going forward. That 75 basis point increase is actually the largest increase at an FOMC meeting or a Federal Open Market Committee meeting in nearly 3 decades, going back to 1994. And normally when markets are selling off, we see bonds, traditional fixed income, serve as a ballast for asset allocation and portfolio returns. But for the first time ever, we're seeing bonds correct simultaneously with stocks. They're down roughly 13% year to date. And so it's been a rough year to say the least. But the focus of our conversation today is private credit, and not all fixed income assets are taking it on the chin. In fact, private credit's been a rising star while both inflation and interest rates have been surging. And now, we look at private credit and we believe they should continue to provide tremendous value to investors' portfolio. Now, with all that said, Chris, before uncovering all the benefits private credit and fixed income can deliver through the market cycles, particularly rising interest rate regimes, I'd love to start with an overview on what is private credit.
Absolutely, and great macro backdrop there, Chris. A lot of data packed in there. Look, I mean, in the historical sense, private credit has traditionally been the concept of middle market direct lending, which is I go out and I directly originate a loan from a small to mid-sized company. Well, as anything in the financial services space goes, often the opportunity set expands and many more types of assets get included in a particular category. So in private credit, that's something that's happened as well. And today, private credit includes real estate credit or real estate debt. CLO debt and equity is a massive part of private credit. Infrastructure credit, asset-based lending, transportation credit. The reality is the lines between public and private credit have started to blur, and you see larger and larger deals getting done in the private credit markets and vice versa. So at the end of the day, I think there's ample opportunity for investors, but you have to do the work and ferret through what's there.
Yep. No, I agree completely. And I think you hit the nail on the head because those lines are starting to blur. And when investors think of bonds, I think in a general sense, they think of your traditional U.S. Treasury bonds or even a corporate bond, say of like Apple. However, as you just mentioned, there's so many different flavors of credit. And I know one of Palmer Square's expertise is CLOs. And then you just mentioned them. I'm wondering, can you enlighten our audience, what exactly are CLOs and how can they add value or hedge against rising interest rates?
Absolutely. If you think about a CLO and you just take one example, a CLO looks like any company. So anyone that's listening that works at a manufacturing company or a technology company or food and drug, you name the industry, CLO in its basic form is the same thing. There are assets, those assets have to be bought with something, so they're funded with debt and equity, right? Just like if you bought a house, a residential house, you can use some debt from a bank, and then you of course put your equity in. CLOs are the same exact construct. In the case of the CLO, though, the assets are broadly syndicated bank loans. So think large loans that are secured, and they're you lend to companies such as Dell Computer or Aramark or AMC Theaters or American Airlines. So those are the assets in a CLO, and that's the really the revenue, right, of your company. You then have the debt. That debt is like any other debt out there. It trades every day. It's very transactable. And then you have the owner, the person who's the equity in it. And if you think about, to your question, Chris, about what's the sort of inflationary, the benefit, well, both CLO debt and CLO equity both benefit in an inflationary rising rate environment, given they are floating rate. And what that means is the rate that is attached to those securities adjusts every quarter. So if rising rates are going up, then a quarter from now, you're getting paid more income as a result. Well, as we know, inflation and rising rate environments really come hand in hand. So that floating rate nature is a massive inflationary hedge that you can use to your benefit.
Oh, great. Thank you. And, it's interesting when you think fixed income, you don't think equity, right? So with normal traditional equity being a natural inflationary hedge, would CLO equity, that tranche, be considered a more of inflationary hedge than the debt tranche?
So if you think about that company, that I described as being a CLO, your assets are these loans and they're floating rate. And then the debt that you issue is floating rate. And then you've got the equity. And the equity is really, at the end of the day, it's not like a true like stock or something you'd buy, the New York Stock Exchange, NASDAQ, et cetera. But in fact, what it is the profit stream that you get, because your assets generate your revenue, you pay your debt holders their interest, and what's left over goes to the equity. Well, what's left over benefits from a rising rate environment. So it is indeed an inflationary hedge. And how it does is you have more assets that are floating rate than debt that is floating rate. So as rates rise, your assets are generating more income. Your debt's costing you more, but because there are much more assets than debt, there's a natural benefit to that profit holder, to that equity person, in the form of additional compensation for the risk taken. So yes, it's not like a traditional stock in that regard, but it definitely has the inflationary benefit or hedge attached to it. Of course, should it be run correctly and used correctly?
Yep, absolutely. And I think it's important, because as you mentioned earlier, there are so many different flavors of credit in general, particularly on the private side. But are they all made equal when it pertains to hedging against inflation? When we look at private credit, do investors just naturally get this benefit because they're exposed to private credit, or are some types of private instruments more advantageous or beneficial to own to hedge against inflation and rising interest rates?
Yeah, incredible question. The way I ended my last answer really tied well into this question, in that, should it be done right and run well? And what did I mean by that? Well, at the end of the day, with anything credit related, and certainly, CLOs fit in that category, traditional private credit and everything I mentioned earlier, you have to do the work. So what we call it internally is do the proper underwriting. That's assessing the credit quality, that's diving deep on the risk, because that is the fly, in the ointment kind of thing, which is if you don't do the work, then all of this is just for naught, right? You're not going to get any of these benefits if all of a sudden all the credit that you're exposed to is defaulting and having trouble. So I think that's a key characteristic. Active management, working with people like a Chris Osmond who know the space incredibly well. I've been doing it a long, long time, and having them advise you, that's critical, especially as you get into markets like this.
Well, thank you. And thank you for the plug. Appreciate it, Chris.
Yeah,
and you just briefly touched on it, on one of the risks, and that's underwriting. And we've talked a little bit about the benefits. What are some other risks associated with private credit that investors should be aware of?
I think when you look at risk, some people define it different ways. So, the first risk is, in our view, and it's paramount, is default risk, meaning I lend to you and you don't pay me back in full, timely interest and principal. That's the most basic risk. And everybody, I think, agrees that's of paramount importance when you're investing in credit. The second risk is interest rate risk. If you have products like we discussed today that have a floating rate nature to them, that you have an ability to have your rates adjust as rates rise. Therefore, you don't have as much interest rate risk. So some are worried about that risk, especially now. That's a second risk. A third risk is volatility, which could come from many different perspectives, and many different ingredients contribute to volatility. What is volatility? Just means your price on whatever you own. How much does it move around in any given environment? Well, in private credit, you need to be particularly careful in some aspects. For example, in traditional middle market direct lending, there isn't a lot of volatility until there is, meaning all along the way, as long as you're getting paid interest, it doesn't show much volatility. But if something happens, then it will have a lot of volatility. For some investors, that's a key context of whether or not to invest. How do you mitigate price vol as your third risk? Again, work with someone who has a strong credit platform, has a disciplined, methodical underwriting process, because you can't just be long private credit and not understand the risks. And those three risks, you can mitigate those. You can never eradicate risk, but you can always mitigate default risk, interest rate risk, and price fall.
And Chris, as you're talking, I can't help but point out that these risks, these are the same risks that actually exist in the public markets, and I think just reiterates your point earlier that these lines are being blurred, and that perhaps one of the main nuances or differences between public credit and private credit is that illiquidity. And that premium that's associated with that illiquidity in the private markets. Would you agree with that statement? Anything you'd like to add there? Or?
No, definitely. I think the different markets also have premiums for illiquidity out there. You could draw that analogy into a ton of different areas. I definitely agree with that statement.
Great. Now, I want to switch gears a little bit. We just cover a little bit about the value of private credit, some of the what is private credit, but I really want to shift gears a little bit and talk a little bit more about the landscape today. And I think in order to talk about today and looking forward, it's always important to look backwards and understand how we got here. So Chris, I'd love it if you could maybe give us, from your perspective, a quick recap on just the evolution of the markets and how within, especially credit, over the last, say, maybe post Great Financial Crisis through COVID and perhaps some of the monumental changes that have taken place within the credit markets within that time period.
Well, you look at the credit markets over an extended period of time, and you've been in a bull market. There's been some periods where that's not the case, but generally, if you look over multi-decade type time frame, it's a bull market. The other part about it is you look over an extended period of time, and we have not seen much in the way of inflation. Recent data that we just all got here this past week, shows that we're some of the worst inflation data in 40 plus years. And that's a long time. So when you recap the history, you got to think about the fact that really there's not a lot of investors out there that have dealt with materially inflationary environments and materially rising rate type scenarios. So that's something that I think the most diligent of investor is paying really strong attention to, because whether it's inflation and of course rising rates attached to it, that's going to impact all sectors, all types of borrowers. Just one other comment, you mentioned sort of the Great Recession and COVID, and I just want to touch on defaults. The other part of the, really the bull market has been low defaults. We haven't seen default rates really tick up in a material fashion over an extended period of time. If you look at the last big default environment, it wasn't COVID. In fact, COVID had minimal defaults. It just had a lot of credit downgrades. The last big default environment was 1999 to 2003. So that's, we're going 20, 23 years, right? So what happened then? Well, that was, of course, the tech telecom blow up. There was a lot of accounting fraud at that point. And you saw a 5-year cumulative default rate of around 23%. But barring that, and to a lesser extent, 2008, defaults have been low. So I think we're in this enormously important credit market from a vantage point of not many people have been here. Higher rates, potential for higher defaults, and of course, inflation that is, as you said earlier, not transient.
Yep. And, as you're talking, I can't help but think of how much value active management in this environment really can play. And to points you made earlier, identifying managers that have experience and a very rigorous diligence process and a focus on quality are really going to add a lot of benefit and protect against those defaults, if they do start to increase. Looking back at COVID, and I think one of the differences perhaps between the public and private markets is, I'm gonna look at CLOs for a second, Chris, and you look at COVID, and there's never been a default in AAA CLOs, right? But the market, I think, perhaps misunderstands that asset class, because they were pricing like a 10, 11% default rate in those assets, but the private markets weren't experiencing that type of reaction. Do you feel that the price, or I should say the CLO market, may be just misunderstood by the public investor?
I think that's absolutely the case. I do think that the misperception, misunderstanding aspect of things has definitely diminished over the years as education's increased. But yeah, you make a great point. I mean, one of the things, I'll tie it all together, you mentioned active management. Well, the reality is when volatility comes about and risk is mispriced, there are opportunities. And when you see something like AAA CLOs, trading 10, 15 points down, that is the epitome of an amazing opportunity. You have a security that is floating rate. You have a security that has never had a default dating back to 1994, which was the start of the marketplace. And yet you have investors pricing in this probability of default that's really not commensurate at all with the risk. So those are opportunities for where a place like Palmer Square, we really pride ourselves on taking advantage of those opportunities. And I love that example, and I could certainly jump into a bunch of other ones. But yeah, that is one of the quintessential case studies in a lack of understanding of what is true risk at the end of the day.
Yep. And, shifting a little bit from, the history, the past, and looking at today's market. And we briefly mentioned the Fed, and they are now tightening. How has private credit fared during Fed tightening cycles?
There hasn't, the only thing is when you think about private credit, if you go to kind of your traditional direct lending, origination from a company and or, working with a financial sponsor to generate those loan opportunities, it's not a huge swath of data. Now, that being said, if you look at the default rates in private credit, they've remained really low. And for managers that have that strong underwriting, that strong credit process, you look at the pressure that rising borrowing costs put on companies. Well, those types of managers run all sorts of scenario analyses. When they do a loan to XYZ company, they're assuming that a variety of bad types of environments could occur. And they're making those loans based on feeling very comfortable that they have a cushion, for example, if interest rate borrowing costs rise, et cetera. So I think from a historical, traditional private credit perspective, we're, with the right managers, even though there's not a lot of data out there, for the ones that have been doing this a long, long time, you've done very well. Now let's switch gears to CLOs. CLOs have been, around since 1994. There's been a lot of different environments. Obviously, the 2000 tech environment I just mentioned, 08, 09, COVID, you name it. And we've seen suffer, I think the numbers are, in over 12,000 ratings given by S&P. There's been around 40 total defaults. And those are round numbers. But the point is, that's a staggeringly high level of accomplishment and really something we think investors should pay good attention to. So overall, I think when you think about Fed tightening cycles and how has general private credit fared, it's fared well.
And as you're talking, Chris, and we've talked a lot about defaults and underwriting, and one thing in the public markets that when looking at, say, bank loans, for an example, you hear a lot about a lot of the loans moving to more covenant light. And yes. Do you find that in the private markets that it's the opposite, that perhaps there's more covenant heavy versus the public markets?
The reality of lack of covenants being present has definitely permeated the private market as well as the broadly syndicated market, maybe to a lesser extent, but it's definitely there. And that's really on the back of a massive amount of dry powder and demand for loan deals, right? Everyone's really competing to be able to lend to a variety of sectors. And so hence some of the terms in those documents that have traditionally been very tight have loosened. I don't necessarily think that is a harbinger of future default increases, but it's something to pay attention to. And it gets back to active management. When you think about covenant light, often just by nature of it, if there being more covenant light deals doesn't necessarily mean defaults, because if you're a really good company and you're a great steward of capital and you're a great management team and your industry has tailwinds, it's likely you've already been awarded Cov Light status and you deserve it and you earn it. The issue becomes when it's the lower quality company at the bottom of the marketplace in whatever sector, and all of a sudden they get it. That's really where you see the issues surface. And we're starting to see some of that, but again, not in a way, shape, or form that would cause us concern from a destabilizing the market perspective.
So we talked a lot about the benefits that adjustable rate or floating rate private credit can provide in rising interest rate environments, but we're also hearing a lot of headlines around deflation and stagflation. I don't think it's outside of the realm to envision a hard landing here, whereby we enter a recession and maybe rates reverse. How would those same assets that have benefited during a rising interest rate perform in that type of environment?
I think the hard landing scenario is one you certainly have to handicap. And we often get asked sort of why. Well, central banks around the world, whether it's the Federal Reserve, it's the European Central Bank, Bank of England, Bank of Japan, they're in an unprecedented situation, whether it's the size of their balance sheet, it's the numbers they're seeing, whether growth, inflation, employment, or at the end of the day, it's also where their rates have been from a historical standpoint. Whatever the case, they can make a mistake. And when you are in an unprecedented situation, the probability of making a mistake is higher. So then you kind of tie that back to the markets that we've discussed today. And, from a interest coverage perspective, which is a massive metric in all of the underwriting that we look at, that other managers look at, all types of private credit managers, that is, we're coming from a position of strength, meaning interest coverage ratios are at very, very good levels, especially if you have a higher quality bias to your underwriting like Palmer Square does. So when you enter into these periods that are lower probability, but still need to be accounted for, you have room to have your debt service costs, still get met and not cause stress on the company. So I don't believe it's going to cause a big problem across the areas as you sort of highlight, but you still have to handicap it. You still have to incorporate a hard landing as part of your scenario analysis, and to not do so, would be a faux pas, upon the back of the manager.
Okay, now let's switch gears here, and one last question before wrapping up. Those are glass half full, that the Fed's going to be successful in curtailing inflation, and we're going to start to see interest rates normalize. And they may fear they've missed the opportunity to invest in private credit. What words of wisdom might you bestow on them?
Oh, I would say that I don't know that I would go as far as to use the word wisdom and bestow on them. I think they are an incredibly talented group, stacked with intellectual horsepower, and they are operating the best they can, and they have the same interest in mind as all of us do, right? Which is a stable market that's growing, that has low inflation. So I really, trust in the fact that they're going to use every tool at their disposal to meet those objectives.
Right. And with those investors, though, that may think that they missed that opportunity for private credit, do you think that's true, or what might? I
don't. I don't think the opportunity for private credit has passed us by. In fact, I think, again, depending on the manager and their approach, especially again, that underwriting is so critical, whether it's CLO, debt and equity, or it's traditional private credit. Today, it's in many ways an unbelievable opportunity given where yields are. The relative value available in private credit is tremendous. And I think that you can also say it's tremendous from an absolute value perspective as well. The key is that avoidance of those risks we mentioned earlier, most notably default. But no, I think it's a tremendous opportunity for investors today, and one that has a lot of diversification attributes that we discussed, and it would benefit a client in their portfolio for sure.
Great. No, I couldn't agree more, Chris. And we at Centura, we believe that private credit holds a place in a client's portfolio, regardless of market environment, and that it really comes down to identifying top high quality managers such as Palmer Square. I want to thank you for coming on today, Chris. It's always great to connect, and always great to have these type of conversations with you. And I've enjoyed our relationship over the years. So thank you, and thank you for all the insight you gave us today on private credit.
Oh, absolutely. Well, thank you, Chris, and congrats on all of your accomplishments. What a great discussion, and hopefully we get to do it again soon.
This has been incredibly educational for the entire audience and myself, of course. So I really appreciate that. Chris Osmond, if people are listening to this podcast and saying, this is kind of my first introduction to private credit, or I've heard about it before, but I didn't know as much as I do now, and they want to ask some questions, and they want to get in touch with you, what's the best way to reach out?
Yeah, of course, you can check us out at centurawealth.com, or you can contact us at 858-771-9500.
Fantastic. All right. Well, thank you so much again, gentlemen, for all your time today. And of course, our last thank you is for you, the listening audience. Thank you so much for tuning in and listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when they come out with a new podcast, it'll show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually helps other people find the show. Again, thanks for listening today. For everyone at Centura Wealth Advisory, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.